If you wanted to segment the crypto world, a magic quadrant would be you've got property, you've got currency, you've got platform, you've got application. The real world metaphor for that would be New York City. I give you $1 billion, Jamie, and you can buy $1 billion worth of land, like 6 blocks in New York City. I don't know what it would buy you today. It might not even buy you 1 block. It might not even buy you 1 block. Or you can buy $1 billion of a building, part of the Rockefeller Center. Or you can buy $1 billion of US dollars in a bank in New York City. Or you can invest in and buy $1 billion worth of companies in the buildings in New York. The companies are the applications. The $1 billion of US dollars is the currency. The building is the platform. The land is the property. Some people, if you have a lot of capital and you want to invest it for 100 years and you don't want to you can't own the currency, right? You know that's going to debase. That's going to inflate and lose its value at 10% a year or more. So you don't do that. Do I want to own the building? Do I want to own the companies, or do I want to own the land? Companies come and go. The building will be around for 50 to 100 years. And the land will be around for 1,000 years. They're just different business propositions. If you don't have a lot of capital, if you have no money, when I started out in business, Jamie, I had $5,000 in a furniture loan. I started a business and I invented something. If you want to go from $5,000 to $1 billion, you need to start a company. You're on the application side. If you have $50 million, you can take the 50 million, borrow 500 million from the bank and buy a building. And that's the platform side. If you have $500 million or $1 billion, you might just buy the land and, wait. One is a more capital intensive strategy. They might all work, but they're for different types of investors. Now, one last risk spectrum I'll give you. There are 4 types of investors. There are savers. Those are people that want to save money for 100 years, and I want to give it to my grandchildren, or I want to endow a park to last forever. There are the investors. I want to invest in a company for 10 years. I'm going to buy Apple stock in 2010 and hold it for a decade because I think eventually people will like this iPhone thing. When you're an investor, you're betting on a portfolio of risk. You're taking risk. When you're a saver, you're converting weak assets to strong assets. I'm taking my dollars and I'm trading them for Bitcoin. I'm trading my bolivars in Venezuela for dollars. I'm trading my pesos for dollars, and maybe my dollars, if I don't want to buy Bitcoin, I trade my dollars for land, or my dollars for gold, or my dollars for collectible artwork or trophies or sports teams. I'm creating something which will not be debased by currency expansion. So savers have a long time horizon. They're risk adverse. Investors have a mid-time horizon. They take some risk. A trader is trying to guess, they're managing a portfolio of risk derivatives, first and second derivative of risk. Will Apple beat their numbers this quarter? Will the 10-year interest rate move faster than the 30-year interest rate? Is there more demand for Bitcoin in Tokyo right now than there is in Singapore right now? Right? You're trying to get in between two things and you're arbitraging it because you're a trader. That's a shorter time preference. You have to have proprietary models, proprietary liquidity information, or lifetime of interest, lifetime of experience in that. And then the speculators, they're like, I went to Vegas, I bet on black, I won. I bet on Dogecoin because Elon Musk was going to go on Saturday Night Live. I thought it would go up. I thought it would go up between 3 p.m. and 5 p.m. on the day that he was going on. Maybe you can trade that, but maybe you're speculating that. If your MicroStrategy, our strategy is to acquire and hold Bitcoin. We're a property development company, almost like a cyber REIT. When Howard Hughes went to Vegas, he looked around, he said, one day there'll be a great city in the desert and people will come here for conventions and to gamble and for recreation and hotels. So he bought all the land. And they're still building houses and buildings on the land that he bought 50 years after he's dead. They built entire cities on land that Howard Hughes built or Howard Hughes bought. He wasn't, 50 years after he's dead, people are developing the land. He didn't know what they would do with the land. He just thought Vegas. Other people created hotels, Sheldon Adelson, he wants to own the Sands and he's in the casino business. It's a different business. If you're good at it, you're good at it, right? And if you're just going to run, and Sheldon Adelson started, hosting conventions. He went from the application to the platform space, maybe had some land along with the platform. Howard Hughes had a lot of money, right? He was a rich man. He just bought everything and he waited. So they're different strategies. MicroStrategy isn't, we don't invest in applications. But I wouldn't invest in a Uniswap any more than I would invest in an individual stock. Like I'm not buying, fill in the blank Uber stock. If you have like a SoftBank and maybe you would invest in Uber or Airbnb, maybe you would invest in a mega unicorn, a big thing in the crypto space. You got to analyze it, right? Uber had regulatory issues. Airbnb had regulatory issues. A lot of crypto things have regulatory issues. I know I have a pretty good feeling for what the regulatory uncertainty is around digital property. Like, am I confident I can buy $1 billion of Bitcoin and hold it for a decade? Yeah. Can I move $1 billion of Bitcoin and not pay tax on it and not KYC it? Probably not. Is that clear somewhere? Not clear everywhere. Do I want to test that? Not really. So if you're a crypto venture, if you're a venture capitalist and you're a startup, you go the application route. And if you're a big mezzanine investor, crypto investor, and you have a higher risk tolerance and you have more capital, maybe you look at some of the bigger cryptos and the platforms. If you're a insurance company and you sell life insurance policies, and you have $100 billion worth of money in sovereign debt that's currently yielding 2% interest, and you're thinking the negative real yield is -5 or -7, maybe you want to move $5 or $10 billion of that into digital property like Bitcoin. To do what? Hold it for a decade, hold it for 30 years. See, there are different use cases, different types of investors. Everybody's got to find their use case. And of course, if you're an individual, maybe you say 40% of my money is going to be into savings. I'm going to put that into some kind of risk off asset. 30% is for investment. I'm going to find the coolest company or the coolest investments I can. 20% or 10% is trading. I trade this algorithm, and 10% or 5% is speculation. If you tell me you want to go to Vegas and you want to gamble and you're going to gamble 10% of your money because you enjoy it, maybe you bet on the Lakers. Like, who am I to tell you can't bet on the Lakers, right? That's your business. Have at it. Just don't gamble so much that you lose your house and you put your kids out on the street. That's irresponsible, right? Don't lose the rest of your assets, and then figure out what your risk tolerance is and what your time frame is. If your time frame is short, I would tell people, don't buy Bitcoin if you don't have a 4-year time frame. You want to go less than 4 years, right? You're more like a trader, speculator. Now you got all complicated hedging algorithms. Don't ask my advice either on that. Like, I don't have any advice for a trader or a speculator. I don't, Dave Portnoy is in the gambling business and he has a lot of fun, and Barstool Sports does their thing. I wouldn't know how to gamble other than I would just take some money and say I might win it, I might lose it. I put a fun wager down.